All right, guys, let's start. So we are now doing your second chapter, which is your fixed income, cash flows and types, right? So we are still doing your fixed income book, and we are moving to second chapter, which is about your fixed income, cash flows and types, right? Again, there is one module, very small. Like the previous chapter, we have only one module, fixed income, cash flows and types. We'll try to understand, right? See, fixed income is considered to be one of the very tricky topic because there are a lot of small things which have to be understood here before we even start moving forward, right? So this module is about your how fixed income in securities generate your cash flows and how your bond features change the timing, the amount, and risk of those cash flows, right? The main idea is a bond is not just your coupon plus principal. Different bonds can have very different cash flow structures, and there are many topics here which we need to understand, right? So let's start digging deeper. So there are 8 topics here. One is your fixed income cash flow structures, one is your variable interest rate, one is your other coupon structure, next is your fixed income contingency provisions, then we have warrants, then we have contingent convertible bonds, then we have legal, regulatory and taxation impact, then we have taxation of bond income, right? So if we start with the first topic, right, which is about fixed income cash flow structures, right? So let's try to understand that. Okay. So in your fixed income cash flow structure, what do we have? So first structure is your bullet structure, means bullet bond, right? So what is a bullet bond? In simple terms, if I talk about bullet bond, a bullet bond pays coupon every period and full principal only at maturity, right? For example, let's say there is a $1,000 par, right? 5-year, 5% annual coupon bond issued at par pays $50 per year, right? So cash flow which are there from year 1 to 4, right? Or what? You are paying your $50 each year. Then year 5 will have $50 coupon plus $1,000 principal. So 1050, right? The key point is principal remains outstanding until the end. From the real world perspective, most plain vanilla corporate as well as government bonds are your bullet bonds, right? Very, very straightforward. Okay. Then we have your amortizing loans. Amortizing loans are your periodic payments, include both your interest and your principal repayment. In that, we have another category, which is your fully amortizing loans. A fully amortizing loan pays interest and principal together in every payment. Example is your home loan, your car loan, your auto loan, whatever. In your early years, interest component is high and principal repayment is low. Over time, interest fall because outstanding balance reduces, principal repayment increases. If you see the example from the slide, right, the present value is 1,000. The rate is given as your 5%, right? Number of years is 5, I by y equal to 5. The FE is equal to 0. You are computing the payment, which is minus 30.97. This is usage of your financial calculator by which this has been calculated. So year 1 interest is what? Your 5%, 0.05 into 1,000 is equal to 50. Principal repaid is equal to 230.97, 230.97 minus 50, 180.97. Opening balance second year is 819.03, right? So this is the calculation which is happening, right? Again, you see here, payment is same, principal remaining is decreasing, every subsequent period when we are going ahead, right? The key point here is over time, interest component decrease and principal repayment proportion increases. By your final payment, principal component becomes 0. Okay. And this is your fully amortizing loans. Obviously, there is something called partially amortizing loan as well. When you talk about a partially amortizing loan, this is between your bullet and your fully amortizing. Some principal is repaid during the life of the bond, but some principal remains at maturity and is paid as a balloon payment, right? For example, let's say n is equal to 5, I by y is equal to 5, PV equal to 1,000, F is equal to minus 200, compute PV, PMT so and so, final payment include $200. Remaining principal, the final payment includes your regular payments plus your remaining principal. The key point is that your credit risk reduces over time, right? But not fully until maturity, right? So that is what we have. Then we have a sinking fund provision. A sinking fund means the issuer repays principal gradually uh, according to a schedule, right? The repayment happen according to a schedule. For example, let's say principal is repaid through a series of scheduled payments over the bond's life. Example is 20 million uh, redeemed annually from year 6 onwards. 300 million is the bond issue. What is the advantage? The advantage for investor is credit risk falls because outstanding principal kind of reduces. There is a disadvantage for investor. If interest rates fall, early principal repayment create your reinvestment risk. The idea is you get your money back early, but may have to reinvest at your low yield. So this is what happens. Then we have waterfall structure, which are there in your asset-backed securities and mortgage-backed securities. Cash flows are divided across tranches. Senior tranche gets paid first. Junior tranche gets paid later. Junior tranche absorb more risk. The key point is interest may be paid to many tranches, but principal repayment follows your priority. From the real world perspective, mortgage-backed securities, asset-backed securities, securitization structures, right? Uh, all these things have to be kept in mind, right? So use for asset-backed and mortgage-backed securities, junior tranches receive no principal until all junior tranches are fully paid, right? Interest payments are still made to all tranches, right? Once we have seen this, right, we go ahead, right? We talk about your variable interest debt, right? So what is variable interest debt? These bonds do not have a fixed coupon. The coupon is linked to a market reference rate. You have a particular formula here. Formula is that coupon is equal to your market reference rate plus your fixed margin, which is the credit spread. For example, let's say market reference rate is 2.3 and credit spread is, let's say, 0.75. So you will add 2.3 plus 0.75, which becomes 3.05, right? If you are paying it quarterly, obviously you have to do divide by 4, 3.05 divided by 4, which is 0.7625 per quarter, right? Which is given here, right? Example is given here. Spreads are often in basis point, 1 by 100th of one principal. For example, 120 pips is 1.2%. We need to understand. The overall idea is that investor receives more coupon when market rate rises and less when rates fall. From the real world perspective, floating rate notes, your leverage notes, your bank loans, etc., are very important to be understood, right? All right. So once we have seen that, we get into your other coupon structure, right? Uh, but our other coupon structure, basically, those are your step-up coupon bonds. What is step-up coupon bond? Basically, coupon increases over time based on a predetermined schedule. Useful when investors want protection against your rising interest rates. For example, year 1 to 3, let's say, is 5%. Year 2 to 6 is 6%. Year 7 onwards, 7%. Right? That is it. Then we have credit-linked, event-linked coupons. Coupon changes based on your credit quality or specific events. Example, if leverage rises, coupon increases. If credit rating deteriorates, coupon increases. If green targets are not met, coupon increases. Key point is that coupon compensates investor for higher risk, right? So coupon in leverage loans, MRR plus 2.5 rises to MRR plus 3%, which was debt EBITDA exceeds 3. Credit linked notes, coupon increases, visual credit rating deteriorates or decrease if it improves. Green bonds, coupon increase if environmental targets, example CO2 reduction, are not met within specified time frame. Then we have payment in kind bonds, PIK. Basically, PIK bonds do not pay coupon in cash. Instead, coupon is added to principal. For example, principal equal to 1,000. PIK coupon is equal to payment in kind coupon is equal to 10%. New principal is equal to 1,100. The key point is that good for issuers short-term cash flow, but risky for investor because debt keeps increasing. Right, that is what we have. And see, the simple idea is that this is issued by highly leveraged firms anticipating cash flow shortfalls, carry higher yields due to your lower perceived credit quality and high leverage, right? Then we have zero coupon bonds, right? Single payment of par at maturity, no periodic coupons. Investor receive one payment at maturity. For example, you buy it today at 750, receive 1,000 maturity. The key point is must trade below par to give you positive return. Advantage is no investment risk, right? And disadvantage is that high price sensitivity to interest rate changes, right? So that is what we have. Then the next part which we have to see is another category, which is your index linked coupons or index linked bonds, right? Coupon payments or principal tied to a published index. Most common example is TIPS, right? Most common types is inflation linked bond linkers, which adjust your cash flows with a specified inflation index, CPI in the US. So TIPS, Treasury Inflated Protected Securities, right? Again, this is given here. We have two categories here. Basically, one category is interest index bonds, which has your coupon rate adjust for inflation, principal remains unchanged, not inflation protected. Another category is capital index bond, principal changes with inflation, coupon rate remains fixed, right? And the key point is, right, that TIPS have a deflation floor. Investor receive the greater of inflation adjusted principal or original par and maturity. For example, 1,000 par, 3% annual coupon rate paid semi-annually. The 3% coupon rate function as a real rate of interest. Investors are fully protected against inflation over the bond's life, right? Now, the other point here is that please keep in mind the coupon rate is real and principal adjusts with inflation, right? Then we have deferred coupon bonds, where regular coupon payments begin only after a specified period of post-issuance. Coupon payments begin only after some time, useful for low-rated issuers, projects which are not generating cash flow, infrastructure, or early-stage products. Zero coupon bonds are the extreme version of deferred coupon bonds, right? So suited for low-rated issuer projects not yet generating income. Zero coupon bonds are the most extreme form of deferred coupon bonds, both often trade below par, right? Then once we have seen that, right, then we get into the next part, which is your fixed income contingency provisions, right? What is the contingency provision? A contingency provision is a clause triggered by a specific event, right? Describes an action triggered by a specific event when embedded in option indenture called embedded options, right? These are your embedded options inside bonds. Some benefit the issuer, some benefit the investor. Then we have straight or the option free category, which has no embedded option. Most basic bond price depends mainly on your interest rate, your credit risk, your maturity, your coupon, right? That's what we have. Then we have callable bond. A callable bond gives the issuer the right to redeem the bond before maturity. Issuer benefit when yield fall. For example, bond coupon can be 6%, market yield falls to 4%. The bond price would rise, but issuer can call it and refinance cheaper. For bondholder, bad news because upside is kind of capped. Please understand when you talk about your callable bond price, it is your straight bond price minus your call option value, right? So callable bond price is equal to your straight bond price minus your call option value, right? So again, the important tuition here is the call option belongs to issuer, so it reduces value for investor. Therefore, callable bond offer your higher yield than your straight bond, right? For example, call schedule for a 6% 20-year bond issued at par on June 1, 2022 is this. Callable at 102% of par value June 1, 2027. First call date, 5-year call protection period, 5 period. Callable at 101 par after June 1, 2030. Callable at 100% par value after your June 1, 2032, right? Issuer benefits, which I told you, when market yields decline due to lower rates or improved credit quality, if yields fall from 6 to 4% by June 1, 2027, the bond without call option would trade at minus 1,224. Issuer can redeem at 1,020 and refinance at 4%, reducing annual interest from 60 to 40.80 per bond. There's definitely a call risk for your bondholder, uncertain redemption rate, call price gaps, market value during call period. Bondholders demand higher yield and pay lower price for callable versus equivalent straight bond. Price difference, which we have discussed, is the callable bond price equals straight bond price minus your call option value to the issuer. Okay. Once we have seen this, right, callable bond, right, then we get into your putable bond. Putable bond is what? If you try to look at it, putable bond is a bond which gives the bondholder the right to sell the bond back to the issuer. Bondholder benefit when your interest rate kind of rises. Credit quality worsens, bond price falls below put price. Again, the formula here is very simple, that putable bond price is equal to straight bond price plus put option value to the bondholder. It's unlike your callable bond price where you're subtracting. Important intuition here is that put option belong to investors, so it increases the bond value. That is why it is added. Therefore, putable bond offer lower yield than your straight bonds. Option has value to the bondholder. Putable bonds trade at higher price, lower yield than your equivalent straight bonds. Exercise when bond price fall below put price due to rising rate or declining issue credit quality. Give the bondholder the right to sell the bond back to the issuer at a pre-specified price, right? Then we have convertible bond. A convertible bond gives bondholder the option to convert bond into your equity shares. The key idea here is, the key term is that we have a conversion price, which is the price at which bond convert into share. Conversion ratio, which is par value divided by conversion price. Please understand that when you talk about your conversion price, conversion ratio, conversion value, you need to understand the definition. Definition is not that difficult. Conversion price, we told, right? Par amount per share at which the bond converts to common stock. Conversion ratio, par value bond divided by conversion price. So $1,000 par bond with 40% or $40 conversion price give conversion ratio of 25 shares per bond. Conversion value, right, is the market value share received upon conversion. Conversion ratio into current share price. In this formula, if the market price of bond is 50, so 25 into 50, 1250, right? So again, please understand that convertible bond give bondholder the option to exchange the bond for a specified number of the issuer's common share. And it's valuable to bondholder as they can benefit from the stock price appreciation. Issuers can offer higher price, lower yield as equivalent straight bonds, right? Bondholder gets debt protection plus equity upside. Issuer benefit because it can issue debt at lower coupon, right? Once we have seen this, we go to the next part, which is your warrants, right? Warrants are what? Warrants are attached to bonds at issuance, right? This gave bondholder the right to buy shares at a fixed price, okay? And for example, right, let's say the strike price is given to you at 40. If share price rises above 40, warrant becomes valuable. Difference from the convertible bond here is that convertible bond converts the bond into shares. Warrant is usually detachable and can trade separately, right? And the idea here is that warrant provide equity upside without immediately converting the bond, right? So overall, you need to understand that there are specific features of the bond which have to be separated and segregated. Callable bond benefits whom? The issuer. Putable bond benefits whom? The investor. Convertible bond benefits whom? Investor. Warrant attached benefits whom? Investor. Floating rate note benefits whom? Investor in rising rates. Zero coupon bond, what is the benefit here? No reinvestment risk, right? So remember that, okay? After doing this, we go to the next part, which is your contingent convertible bonds, which is COCOs, right? Which is also called COCOs. Basically, our COCOs, think of COCOs as your debt that turns into equity when things go bad, right? Not optional like your convertible. There is a automatic conversion, right? So contingent convertible bond that can automatically converted from debt to common equity if specific event occurs. Issued primarily by European banks to help meet your regulatory equity requirements. Regulatory compliance has to be done. Banks are required to maintain minimum levels of equity financing under regulation. COCOs are typically structured to convert to common stock if the bank equity falls below a specified threshold. Conversion simultaneously reduces debt liabilities and increases equity capital. This helps the bank comply with the minimum equity requirement without raising new external capital, right? So we have a trigger mechanism. Conversion happens when a trigger event occurs. Capital ratio falls below threshold. Example, CET1 ratio. Bank stress or the regulatory trigger are also the triggers. Why do bank issue COCOs? Because this is pure Basel or the regulatory engineering, right? Banks must maintain equity capital, but equity is expensive, so issue COCOs which behave like debt in good times, equity in bad times. What exactly happens in trigger is that your goes down, liability reduce, equity goes up, conversion into your share, balance sheet strengthens automatically. The key idea for the exam here is that COCOs are loss absorbing instruments used heavily by European banks post 2008 crisis. Investors' perspective, these are risky, but these give you high yield. There is a risk of forced conversion at the worst time. You become equity holder when the bank is weak, which you might not want. But again, this is where the risk and return comes into play, right? So this is what it is, right? So this is done. Then we get into the next part, which is your legal, regulatory, and taxation impact. Now, this is classification plus your global bond market understanding. You need to understand your domestic versus foreign versus your euro bond. When you talk about domestic bond, those are issued in issuer's country, traded in same country. When you talk about your foreign bonds, issuer is foreign, but bond is issued in local market. For example, UK company issuing USD bonds in your US market. That is your foreign bond, right? They're also called sometimes Yankee bonds, right? Yankee bond is the foreign bond, right? Eurobond is most confusing. Why it is most confusing? Because issued outside any single country's jurisdiction, not about your euro currency. For example, US bond or USD bond issued outside US is also your euro dollar bond. Yen bond issued outside your Japan is your euro yen bond, right? So very interesting. It's not about euro currency. USD bond issued outside US is your euro dollar bond. Yen bond issued outside Japan is called your euro yen bond, right? The key difference is that when you talk about your domestic bonds, issuer is local, market is local. When you talk about your foreign bonds, the issuer is foreign, market is local. When you have euro bond, issuer can be anybody, and your market can generally is offshore or your multi-count, right? So remember that point. Very, very interesting thing. For the global bond, euro bonds that also trade in at least one domestic bond market, international bonds, collective term for foreign bonds, global bonds, and euro bonds involving more than one currency, right? Okay, so we have done that. Another point to understand is that what are the key of your legal, regulatory, and taxation impact. One is the key yield driver is the currency of denomination drives your yield. Why? Because interest rate is equal to your function of currency economy. And you have your sukuk, right? Bonds. This is a fascinating form. This is a fascinating from a structural standpoint. What is sukuk? It's an Islamic finance bond, right? And the key rule is that there is no interest, which is also called riba, right? So how do they generate return? They generate return through your asset-backed cash flows. For example, investor own part of asset, gets rental income. The key idea is sukuk behaves like your lease or asset participation, not your lending, right? Restrict payment of conventional interest and restrict use of bond proceed. Periodic payments are structured as cash flows from into underlying assets, right? Once we have seen this, we get into the next part, which is again taxation of bond income. Again, this is very exam heavy and your tricky kind of topic because here we're talking about interest income, which is taxed as ordinary income, same as your salary, right? Then we have your, there are definitely exceptions, your municipal bonds, right? They are often tax free, right? So we keep that in mind. Then we have your capital gains income. If bond is sold before maturity, gain/loss is your capital gain, usually tax lower than interest. Long-term gains even lower, right? So that is very, very important. Then we have your original issue discount, which is OID. This is where many people get confused. What is OID is that it is a zero coupon or deep discount bond. For example, buy at 700, maturity at 1000. And we look at tax treatment, even though no cash is received, still annual price increase is taxed as interest income, right? This is again very interesting. You have to remember price appreciation treated as interest income, not capital gain, can create a tax liability even with no cash received. A portion of the issuance discount is treated as taxable interest income, which each year in many jurisdictions, right? Then we have some premium bonds, right? Okay, when you talk about premium bond, a bond is bought above par, premium can offset your taxable coupon income, right? So that's one part, right? All right, with this, we have completed the theory part of this topic. Let's go into some questions now. Let's try to understand. Delo, Digistripe Logistics is a Canadian firm that generates a large proportion or portion of revenue in Europe. To finance its planned expansion into digital logistics, Delo is seeking to issue the euro-denominated bonds to institutional investor in Germany. Term sheet for the proposed bond issues presented below, right? So you have the issuer, you have the settlement date, maturity date, principal amount, 250 million unit size, 1,000 per bond, interest, seniority, conversion provision, current share price, conversion share, and your conversion period, right? So once we have seen all these values, right? All these values, right? Then we get into the question, right? Okay. So the question here is that institutional investors have expressed concern about increasing credit risk due to Digistripe's planned expansion outside core business. Digistripe CFO would prefer to fund the expansion using debt, despite an expectation of lower market interest rate in the next few years. The CFO is also considering removing the conversion feature because of concern about the possible share dilution if the bonds are converted to equity, and I believe the dealer shares are significantly undervalued, right? This is one of the company's own management prediction, right, or expectation, right? Now, the question is, which of the following statement best describes the type of bond to be issued when the issuer country and where the bonds will be issued and traded, right? See, again, if you go back to the question and read the question carefully, this is a Canadian company issuing euro bond sold in Germany. So this is a foreign issuer, right? Plus your local government or local German market, right? So answer is your B, right? Which is your, since this type is planning to issue all denominated bonds to invest in Germany, its bond will be considered foreign bonds, right? Okay. Once we have done this, we get into the next question, which is which of the following modifications could Digistripe incorporate to best mitigate the investor credit concern? Again, your duty is to reduce the credit risk. Investor concern is credit risk. So what helps here is that if you have faster principal payment, if you have permanent loan coupon, that is good thing. So we don't want your what do you say, deferred debt payment or principal repayment, because we want faster, right? Each type could consider adding a call option. We don't want that also, because that's the issuer benefit. Deferred payments, which was there in first option A, it increases the risk. So overall, this type could consider accelerating principal repayment or linking debt coupon changes to financial covenant, because we are worried about in credit risk, and faster principal repayment and covenant look coupon help here, right? Which of the following is the best contingency feature Digistripe would add to mitigate its own concern regarding the lower interest rate? Again, if you want that refinancing is cheaper if rates kind of fall, what helps here is a call option, right? You add a call provision to the proposed new debt. So that is what is a good thing. If Delo's share price on the Frankfurt Stock Exchange were to rise euro 75, the bond conversion value would be what, right? See, understand, if we are trying to figure out, right, the conversion value is basically the par value, right? Conversion value is the par value. So answer here is A, right? So answer here is A. Conversion value is nothing, right? Is the par value. Okay. So we have done this. Then we go to the next question, which is which of the following statement best describes the implications of removing the conversion feature from the bond, right? So if convertible bond, which is valuable to investor, if the feature is removed, investor loses your upside, bond becomes less attractive. So you should first your increased coupon, price increase is wrong, your credit risk change is wrong. So answer is that you have to increase your coupon, right? So that is what it is, right? So overall, what you need to understand is whenever you see the bond feature, ask who benefits. Issuer benefits when the price goes down, yield goes up. Investor benefit when the price goes up, yield goes down. What risk is being modified? Credit risk is captured in your amortization covenants. Interest rate risk is captured in floating versus callable. Equity upside is captured in convertible and warrant. What happens? Stress is POCOs, convert, callable, issuer acts, putable, investor acts, right? So that is what we have, right? And you can we have solved the question, 5 question, but you can read all the answers here. So this is given here exactly, right, what you want, right? So especially question number 4 was very tricky. The conversion value of bond equal to par value if the current share price and conversion price are equal. Conversion ratio is equal to convertible bond price divided by conversion price. We know that. conversion value equal to conversion ratio to current share price, or rearranging conversion ratio to conversion value by current share price, which can be substituted in the left hand side of the first equation. So if current share price equal to conversion price, then conversion value is convertible bond par value, right? And again, question number 5 is also interesting because the conversion provision is valuable to bondholder. The convertible bond price is higher than the price of an otherwise similar bond without the conversion provision. Similarly, the yield on a convertible bond is lower than the yield on the otherwise similar non-convertible bond. Thus, should the this type team effort to remove the conversion feature, it will likely to have to increase the bond's coupon rate in order to attract investors, which I told you, right? With this, we have completed this chapter, guys. I hope you understood. Not very long chapter, but here the difficulty is much higher than your chapter number 1, right? Because here we are getting into coupons, maturity, etc., conversion value, conversion factor, right? Conversion ratio, convertible bond, how to calculate the values, and what to keep in mind, what not to keep in mind, what is the effect of yield, right? So last 5 questions are very, very tricky and also very interesting, right? Go back, revise it. I'll see you in the next lecture. Okay. All right, guys. Thank you.